You're listening to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Join Ryan every Monday on the Big Talker 1580 AM from 2 to 3 in the afternoon. He'll cover real estate from every angle under the sun. Call Ryan on air at 877-245-2030. That's 877-245-2030. If it's real estate, it's covered on Real Estate 360 Live with Ryan Sloper.
Welcome, everyone, to Real Estate 360 Live with Ryan Sloper. I am your host, Ryan Sloper. Happy New Year to everyone. This is our first show of the year. Last week was obviously a holiday, so we weren't airing. For those of you who are not familiar with the program, my guest and I will cover every angle of real estate, from interest rates to the economy to what's happening in Washington. Anything that affects real estate in our local area that could affect you, we're going to cover. You have credit issues, you can call me. If you want to refinance to the lowest rates in U.S. history, you can call me. If you've got questions, I've got the answers. Make sure you join us every Monday from 2 to 3 p.m. right here on 1580 AM, The Big Talker. If you have any questions, the off-air number to call is 877-245-2030. That's 877-245-2030. Remember, if it's real estate, it's covered here. Today, we're going to have a special program lined up for you guys because we want to really jump in to what our bold predictions for 2012 will be. Now, as far as predictions, what we want to jump into is, where do we see the general economy going? What will the elections bring us as far as real estate in the general economy? Where will interest rates go? Will they go up? Will they go down? Will they stay the same? Where will gold, oil, and silver prices go by the end of 2012? And what's going to be the big theme for the year when it comes to foreclosures? We've had a lot of different conflicting reports for what people think the foreclosures. We have this glut of inventory that has yet to come to market. A lot of prognosticators are saying that we're going to have a record year with the foreclosure market. We want to jump into that as well. Joining me on our panel today is Louis Cammarosano, the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you our predictions for 2012. So you should really make sure you're taking careful notes, because this could really affect, whether you decide to refinance or buy your home in 2012. Louis, are you there? Louis, can you hear me? Well, while we try to get him on the line, I think he should be there in a second. Louis, you there?
I'm here, Ryan. How are you?
I'm doing well. How about yourself, sir?
Grandiose.
So
Happy New Year.
Happy New Year to you as well. So we have a big big topic, basically just giving our bold predictions for 2012, and there's a lot of individual subjects that I'd like to dive into, but just overall, like what do you think the prevailing theme is going to be for 2012 with all things real estate?
Well, for the first few months, I think more of the same, working off inventory. But then I expect some type of financial shock at some point during the year, and based on either European debt levels or something in the United States. But I don't think you can. Those things are inevitable. What's going to happen, but we don't know if they're imminent. So you really can only plan your finances and your home buying around where we are now. And when I say more of the same, I mean low interest rates and a housing market that's somewhat tepid.
Yeah, and I tend to definitely agree with you, Louis. I think that, ultimately, I feel that interest rates really don't have a choice but to stay kind of around the same range that they've been in, 4 to mid fours for most of the year. That's what I'm, going to step on a ledge to say. I don't really see them, jumping up into the fives, and I don't see them coming down to 3.5% either.
I agree with all that, unless there is some type of financial cataclysm or there's some Lehman moment that we have during 2012.
You bring up a good point, because you did, you briefly touched on Europe, and if I'm not mistaken, I believe Sarkozy and Merkel were meeting today trying to figure out some sort of plan. I read that they were looking at implementing some sort of tax structure on basically financial transactions, and I really don't think that that's like going to be the fix to the problem. I really don't think. I think ultimately this could be that big event that you're talking about that could have, effects throughout the world, not just in Europe.
Right. There is no way to really solve these issues other than allowing the debt to be liquidated. But none of the central banks seem to be headed in that way, and it's just a question of how much longer can the debt levels be sustained in the Western world.
Right. Yeah, and we've talked about this for over the last year, just about how we, not only the U.S. but Europe, we're kicking the can down the road, and ultimately somebody's going to have to pay the price. Who's ultimately probably going to end up paying the price is, we the taxpayer. It was interesting, Lewis, because I was reading this morning. Everyone's talking about how great these low interest rates are and what that means for potential buyers right now. If they do have a stable income, if they do have money that they can put down for a down payment, they can qualify for a mortgage at this time, that they have these awesome, great 4% or below interest rates. And at the same time, I'm reading how, we are now, that bill that was just passed through, which was the payroll tax cut, in that bill, it was cited that we're paying for that via new mortgages. They're going to be implementing basically like a tax on new mortgages. So Fannie Mae and Freddie Mac, conventional loans, you're going to be they're basically going to be passing what amounts to close to 1/8% in rate hike by that tax.
Well, that's a backdoor bailout of Freddie Mac and Fannie Mae, though, isn't it?
I think so. And there's so many of these ancillary fees that are going on that are being passed,
and a tax on the real estate market.
Yeah, absolutely. So, on the one hand, we would think that, the rates are, they're great, they're going lower, but actually they're going to go higher because there's more of these taxes that are coming down. It's getting more expensive. Just to give you a good example, an FHA mortgage since 2008, the FHA monthly mortgage insurance rate has more than doubled since 2008. In 2008, it was 0.5% for the monthly mortgage insurance premium. They just, in that same payroll tax bill that I was just talking about, it's also going to raise the rate of FHA annual mortgage insurance premiums by another 0.1%. So,
that's 20%. It doesn't sound like much, but it's 20%.
Absolutely. And FHA is kind of sneaky because instead of affecting the interest rate, they just changed the monthly mortgage insurance premium. So people that are currently in an FHA loan, which is a large percentage of the population now because it has the lowest cost to enter the market as far as down payment's concerned. A 3.5% down payment is all that is required. So if in 2008 it was 0.5, but now it's 1.15, that's more than double. So you're really, even though the interest rate could be 4%, it's still actually limiting the amount that a person can qualify for. So I think that with this being said, it's like I really think that interest rates themselves should be lower, but they're not. And realistically, I would think that we would be closer to more of like a 3.5% 30-year fixed mortgage. But with all these other fees and taxes and everything else that the government's imposing with these backdoor bailouts, is actually keeping them around that 4% range. And I really don't think that we're going to be able to see interest rates come down that much lower. And if people are out there and really saying to themselves, I think this is going to be the year where we're going to see interest rates hit down to 3%, and I'm going to take advantage of them then. I think that that's a mistake because I think that there is more of a chance of the rates actually rising than they are to fall, especially with all that we have going on in the economy. Would you agree, Lewis?
I would agree that a lot of potential home buyers are holding off thinking that interest rates will either stay at this rate for the next year or so or go lower, and they're waiting for that, or they're expecting further price declines in homes because they think that the shadow inventory and the inventory on the foreclosures is going to be released. But the more likely thing that's going to happen is you're going to have inflation, and if you're a renter, that's going to hit your rent. So you're better off banking on, I think, higher inflation, which means lock down your low interest rate long-term now to protect yourself against your cost of shelter going higher when your rent goes up, and that'll also allow you to absorb some price decrease in your home because if you're still paying your 4% mortgage, your cost of the home aren't really going up at all. So I think that's probably more likely the scenario given the macroeconomics that we're seeing with the excessive debt and money printing, which will probably cause a serious spike in inflation in the next 2 or 3 years.
Absolutely. I mean, I think we're going to go through a definite hyperinflationary period in which the people that have locked themselves into long-term fixed-rate cost mortgages, 4% or sub 4%, depending upon your qualifications, they're going to be in a good spot. Because if rents continue to rise, which they will, it's just inevitable. Especially in the D.C. metro area. Lewis, matter of fact, you had sent me an article last week on, us becoming a renter nation. And the D.C. market is actually a prime example of that. We have very low inventory of houses that are actually on the market to be sold, very low inventory of rentals that are on the market. Prices are increasing. I mean, the article said around 5%. I'm telling you, they're probably 10 to 15 to 20% in certain areas. And that is very likely to continue. If, you don't take advantage of buying just to lock in your long-term cost of home ownership, 3 years down the road, to be able to afford the same size house, you might not be able to. You might be forced to downsize into something as a rental.
And Ryan, think of the people who aren't buying now because they want interest rates to go lower. Well, They certainly aren't going to buy when interest rates go higher in response to higher inflation. So at that point, then, it's going to be even more difficult to get yourself a home because your cost of ownership will go higher because the long-term interest rates on your loan will go higher. So if you lock in now, you're at least hedging yourself against when interest rates and rental prices go higher.
Absolutely. You're listening to Real Estate 360 Live with Ryan Sloper. My guest, Louis Cammarosano, is joining me discussing our bold predictions for 2012. And, Louis, I really think that,
I don't know if they're so bold.
Well, not necessarily bold, but, they're probably, I guess, what everyone would guess that's going to happen is probably what's going to happen. I think that, you had just brought up the interest rates, and I think it's actually people have come to expect that they're going to get interest rates in the 4% range. Louis, so it would be very interesting to see if they actually did go the other way. What would happen? What would happen to, the overall sentiment among, potential buyers?
It would be a disaster, but more so for the United States government because the debt service would be unsustainable. It already is, but I mean, if we had to pay more than we're already paying, then it would be a catastrophe. So the Federal Reserve and all of the central banks have a vested interest in keeping interest rates as low as they can indefinitely in hopes that they can inflate their way out of the debt that they've incurred. They can't raise interest rates to market levels.
Yeah, you're exactly right. I mean, you figure, and what investor wants to be lending money at 4% right now?
Well, what is the 10%? And I think in the U.S. Treasury, it's under 2%.
Yeah, it's sub 2%, right? I mean, that kind of yield. I mean, it's just not. It's not sustainable. It's not good business.
Yeah, and I don't know who's buying those. I think aren't those the bonds included in Operation Twist, where the Fed is selling off their short-term securities that they bought and just rolling them into the long-term just to keep that rate down.
Yeah, and I'm sure that there's something baked into there as well, with the banks being required to buy some of that as well. And
also, you notice, I know you wanted to talk about gold and silver today, but institutional investors buy that as well. And on the concept that somehow it's safe and it's secure and it's guaranteed by the U.S. government. So there's a wide market for treasuries, not just because the Fed buys them, but internationally and then with institutional investors.
Yeah, it's interesting. Where a lot of institutional investors are buying up this thinking that it's safe because it's our government. We're going to pay back. But, I mean, ultimately, we're going to end up probably at some point in the same position that Europe is in. And anybody that thinks that we're different, the only thing that makes us different is that we have a printing press. And that any time that we want to turn it on, that's what we do.
That's true. It's a lot easier nowadays. I was reading a story where we don't even really print as much money as we used to. Obviously, it's now more done digitally. Exactly.
That's actually one of the problems that we do have is that, all those zeros that you see going across on these bank ledgers, there's not that currency in play right now.
And people say it's easy to print money, but you do need cotton and paper to do it, and you do need a printing press, but that's not what's happening.
Yeah, it's not, and I think that this is just going to be another continuing trend throughout this year going into the elections. Very interesting to note that over the last couple periods of time that they've been measuring the unemployment rate, it's mysteriously been getting better. I'm not really sure how that's happening, to be honest, Louis. I really don't think that it's accurate. I think that information that's being put out there is being kind of misleading. We've talked often about the 99, after you're over 99 weeks on unemployment, you fall off. There's a lot of those people out there. When we come back, we're going to jump into what we think the employment situation is going to be in the U.S. for 2012, and also what's going to go on with foreclosures. Will there be more to the market, or will it be more of the same when we come back? Thank you for listening to Real Estate 360 Live.